Look, I think you can't put too much faith in the numbers for the first few days we've seen of 2016 so far.
Matt Felsman, Happy New Year. Welcome back to Dukascopy TV.
Yeah, Happy New Year, Nat. Good to be here.
No worries at all. Okay, so last time we spoke, we discussed the blue chip stocks not really pulling their weight on the ASX, and that seems to really have translated into investor sentiment with confidence low as we head into 2016. How really do you see this kind of driving and moving forwards, and what are you hearing really from clients?
I think when we spoke last, we discussed how the Australian market in general, which is largely banks and miners, had really suffered some headwinds over the last year. Clients are looking into their portfolios and seeing 10, 20, 30% losses in some of these top 20 core Australian stocks. So it has rattled people's confidence. People are obviously sort of wondering what the year ahead holds. What I've been trying to say to clients and have been saying for the last few months is, have a look in other areas. Have a look over in Europe's a great example. Quantitative easing is taking place over there. We've got a focus at the moment on smaller stocks that have maybe a little bit more earnings per share growth, so small to mid-cap stocks. And look, you'd be surprised how many actual sophisticated investors haven't ever shorted a stock or haven't ever used things like put options to protect portfolios. So overall, it's thinking out of the box a little bit, looking at other markets and maybe looking at a few smaller ends of the market that people haven't looked at before.
Well, in terms of other markets, obviously China's really spearheading concerns surrounding global growth at the moment. But with that said, we've seen the outlook on US equities has been downgraded. Hedge funds in London, for example, didn't really do so well in 2015. Is this low investor confidence almost perhaps justified, or are we seeing sort of over-exaggerated market response to recent events?
Look, I think you can't put too much faith in the numbers for the first few days we've seen of 2016 so far. A lot of people haven't actually returned to markets. Investors are, away from their desks. So when we typically see a lack of volume, we see increased volatility. So, intraday we're seeing these 200 point moves in the Dow and on the FTSE, recoveries, drops. So typically we do see increased volatility when there is a lack of volume, and obviously a lot of people still haven't returned to the market for the new year just as yet, so it might be a little bit exaggerated.
We saw, volatility really characterised 2015 and looks like it could be sort of a common thread coming into the new year. Does that, you mentioned obviously we can't make that much from the early days of 2016, but does that level of volatility, if we take the lessons of last year, make it difficult perhaps to make forecasts and to create an outlook for the investment year ahead?
Yeah, 100%. It is very difficult to forecast, and a lot of this is largely due to some of the headlines and news and things we're seeing coming out of China. And the more broader Asia Pacific region, areas like Korea and these geopolitical events on one hand, but China is a great example. We probably will see volatility periodically moving ahead this year, and that's due to the fact that the market is not trading in comparison to Australia, a fair and orderly fashion. It's a managed market. We're seeing opening times managed by the authorities over there. Certain percentage moves trigger stops or closures of the market. People are allowed to borrow a large amount of collateral against large amounts of margin loans and use collateral that's not marked to market. It's a very managed market, and when people actually try to make investment decisions on that, they can't look at stocks fundamentally. They can't look at stocks technically. It's pretty irrational. So we will see some large volatile times that usually will get calmed down by authorities, and then calm sort of returns will be quite volatile, probably periodically, largely out of China.
Could we see then a greater leaning towards, macroeconomic data being sort of a guide for investors? We've got US NFPs coming up. There's still expectations of what the Fed could do and whether we could see further hikes. We've also got, speculation regarding, what the Reserve Bank could do with interest rates here in Australia. Could they be greater guides and sort of light the way, as it were?
Well, look, information and economic announcements this week at least will be quite key. Towards the end of this week, so Thursday, Friday and Saturday, we see some of the first large data releases out of the US. And this will be a welcome distraction from all the Chinese type focus and oil type focus we've seen over the last week. Also, with more funds and more funds, investors' funds returning to the market next week and in the weeks ahead, this should set a really good tone and direction for how things trade. Should add a little bit more of a rational approach to the way things move. Also, coming into the equation at the start of February, we have the Chinese New Year celebrations, which actually closes Chinese markets for a week. So information that's coming out at that period of time as well will probably have a chance to trade more on its merits rather than some of the moves we've seen in the last week or so.
Matt Felsman, many thanks for the update.
No worries, thank you.
We'll certainly be catching up with Matt Felsman into the new year. Sadly, that is all we've got time for right now, but do stay tuned to Dukascopy TV for all of the latest interviews and analysis. I'm Natalie MacDonald. You've been watching Sydney Direct on Dukascopy TV. Goodbye for now.